that drives that range higher on each day and pushes the prices down. And when we get down towards the bottom there, once that the sellers have been, you know, picked off and taken out, there are signs that things are going to turn around. The 21-day average gives us just that little smoothing signal. It's never going to be 100% exactly at the bottom because it is an average, but it at least gives us a sign. What it gives us a sign of is that the spikes in volatility are beginning to fade away. And then it's the point when it turns over, that's kind of the signal when the move to the downside is exhausted. Any questions on volatility?
You could run a scan to see 3 spikes above 21-day.
I think you could, because and you also have to be. I was looking at doing that, and it's because there may be day 1's a spike, day 2 isn't, day 3, day 4 is a spike. It's in most cases, it's almost like you need 3 out of 4 days of spikes, because you may occasionally get one that doesn't get up in there, but you could write a scan for that very easily. You know, that's the initial trigger, is you got 3 out of 4 spikes, but during that time, you're going to have the 21-day average is still going up, because that's the crucial factor here. And all of these here, this is the initial trigger, is the spikes above here. I get 3 days in a row above here, but it's still moving up. So I'm going to get hits all the time, all the way up here on that initial scan. But what I'm really looking for is for that to have occurred once I find a date and time and I've gone back, oh, okay, the last 4 days I've had 3 spikes above the moving average. Now I'm waiting for the moving average to have been going up and then turned down. So you've got to get that relationship's got to be in place. Because, you know, there's times when this thing turns up and turns down when you don't have spikes. So once those two factors are together, I think it can be written, yeah. Be interesting to test it.
Steve?
Yeah.
Why do you keep saying that this is an end of a short? I mean, this volatility stuff's funny anyway, because volatility should just mean movement. But the way it's used in stocks is, if the thing's going down, it's got high volatility. If it's going up to the moon, it's got low volatility. Well, to me, both of those things are volatility, but that's the way the stuff is measured. So, or called.
Called, yeah. Miscalled. Naming is
So-
a convention,
So
yeah.
why wouldn't you, I mean, I don't know what your trigger in to short these guys was, but why wouldn't you use these volatility spikes to enter longs as you closed out shorts? And let's see what the difference is.
Oh.
Why are they so much better for shorts than they are for just going long?
No, you're right, you could. I mean, what I was doing here was looking at exhaustions of moves. So
that's your talk.
that's the talk.
I was going to say, for
Yeah.
God's sake, Steve, you're giving up half your money.
No, exactly, and that's what I'm doing here. Is that's it. But like we saw earlier when we were looking at the expansion, the gap, the exhaustion gap, it's this great short opportunity. So, you know, it's the same thing. When a move's gone from one side, you can always play the other side. So you're good. Yeah, so I'm focused on there. We could do another session and say, we could relabel this session, and I could reverse it all and say, hey, these are great opportunities to go long or short. But no, it's a good point. But you're right. This is kind of interesting for that too, because every time you get this little rollover, especially after these spikes like here, you could probably look at going long. I haven't really looked at it because that wasn't the theme, but nice. I like it. I mean, it's something I hadn't looked at before. I hadn't seen. You know, I read Stocks and Commodities. It's like my, it's one of 2 magazines I read. It's Stocks and Commodities and The Economist, and there couldn't be 2 more different magazines. I mean, The Economist is a great magazine. I don't know if anybody gets The Economist. It's to me, it's probably the best summarized worldwide news without all the inflaming and all the media hype. I read it every week. It's extremely in depth. Whereas the Stocks and Commodities, after the first article, I generally fall asleep because it's just so complex. But there's always some gems in there somewhere, and then you always pick out things. And I hadn't seen much on volatility recently because they move a lot into doing currency things. They do some very esoteric stuff. It gets a little too complex. Simplicity, I think, is always the best. Things I can understand, I find are really, really important. And this I understand. I understand what happens when the sellers have all given up, and this is just a simple measure of it. So we've got one more to do in here on volume exhaustion. And we saw this in a couple of the examples we looked at. When you get to the end of a move, especially to the the peak of a move to the upside, the volume just fades away. So again, I look for the today's volume ESA to be highest for 21 days is a good indication, because volume spikes on their own, there's just too much noise. So go back down and look at the 21-day average of it, and wait for that to reach a particularly high level. Here's some EDS code for that. Very simple code here. All I'm looking for, it's a new volume high. If the high result of the volume average of the 21-day equals the volume ESA, I would probably substitute. I want this not to be equal. It doesn't have to be exactly equal the ESA. What I'm really looking for is it to be greater than or equal. So what we're seeing here, all this is looking at a new high volume peak. So in this one here, we looked at the tops of moves. You tend to get different types of volume things happening at tops and at bottom of moves. So this is a SLB with 21-day high volume ESA exit. Again, it's very interesting. You get these little volume peaks here. You can see the ESA suddenly pops up here, right at the bottom of this particular move here. Over here, you get it up towards to the top of the move. Down here, we saw the huge increase in volume. This is a 21-day high in the ESA volume, and it's right after the bottom of the move here. It's not a bad indicator. It's not as good as the volatility I find, but it's again, when you see that, if you run a scan with looking for high 21-day volume ESA exits, you could use it for trading shorts, especially up here, or trading long down here. What's interesting about this is that you get these, unlike huge moves to the upside where your volume fades away, sometimes you get this volume thing happening right at the beginning of the down move. You get that sudden spike in the 21-day average volume right here. So in this particular case here, you've had a great move to the upside. Look at the volume fade over here. This is kind of the sign that we're beginning to have a real breakdown. The move is over really over here. The volume has become fairly anemic right here. The volume's faded away at the top of the move, but this is the sign that things are beginning to pick up again. None of us can grab the tops of these moves if we want to go short. But again, if you see this right here, the volume is starting to pick up.